Tankers stopped moving. Crude prices quadrupled. Within months, inflation spread across 3 continents. In October 1973, a statement left several ports in the Persian Gulf without ships. By the end of that winter, gasoline lines circled blocks in Chicago and Rotterdam. The price of a barrel of oil moved from roughly $3 to nearly $12 in less than 6 months. What had appeared to be a stable input became a variable no central bank could control. The interruption began with a war. On October 6, 1973, Egyptian and Syrian forces crossed into Israeli territory. Within days, members of the Organization of Arab Petroleum Exporting Countries restricted exports to nations seen as supporting Israel. Production quotas were cut. Cargoes were delayed. Some shipments never left the dock. At first, energy traders treated it as a temporary disruption. Oil had flowed reliably for years. The major producers, Saudi Arabia, Kuwait, Iran, had long operated within an established pricing structure negotiated with Western oil companies. The assumption was that political conflict would remain separate from supply. That assumption held for less than a week. By late October, the posted price for Saudi crude had doubled. The New York Mercantile Exchange saw contracts rewritten in hours. In London, spot cargoes traded at levels that made long-term supply agreements irrelevant. The official statements described adjustments. The invoices showed something else. The price shock traveled through invoices and shipping manifests. Refineries paid more. Utilities passed costs forward. Airlines recalculated routes. Within a quarter, consumer price indices began accelerating. In the United States, inflation moved from 3.4% in 1972 to over 8% in 1973, then above 12% in 1974. In the United Kingdom, it reached 25% by 1975. The initial losses were visible at the pump. The secondary effects were larger. Manufacturers faced higher input costs across plastics, chemicals, and transport. Wage negotiations adjusted. Labor unions, observing prices rise monthly, demanded compensation for anticipated inflation rather than realized loss. Contracts began to include automatic cost-of-living adjustments. Indexation became routine. What had begun as a supply constraint became embedded in expectations. Central banks were not unprepared, but they were constrained. The U.S. Federal Reserve had already loosened policy in the early 1970s to counter a slowdown. The Bretton Woods system had collapsed in 1971, ending the dollar's convertibility into gold. Exchange rates floated. Currencies adjusted daily. Policy anchors were weaker than they appeared. In Frankfurt, the Bundesbank faced imported inflation as oil invoices arrived in dollars. In Tokyo, the Bank of Japan saw the yen depreciate against a commodity it could not produce domestically. The response, initially, was cautious tightening. Interest rates rose. Credit slowed. The expectation was that demand management would offset supply pressure. It did not. By 1974, output contracted across several industrial economies. U.S. real GDP fell. The United Kingdom entered recession. West Germany slowed sharply. Inflation, however, remained elevated. The combination acquired a name: stagflation. The term suggested a paradox. Growth stalled while prices continued climbing. The prevailing models had treated inflation and unemployment as inversely related. The Phillips curve had implied trade-offs. Now both moved in the wrong direction. What happened next would alter policy frameworks for a generation. Oil exporters accumulated surpluses at a scale not previously recorded. Saudi Arabia's revenues expanded severalfold between 1973 and 1974. Petrodollars flowed into Western banks, particularly in London and New York. Those banks, in turn, sought borrowers. Loans extended to Latin American governments increased rapidly. Balance sheets expanded. The immediate crisis appeared contained by mid-1974. The embargo formally ended in March of that year. Production gradually resumed. Prices, however, did not return to prior levels. A new baseline had formed around $10 to $12 per barrel. Energy costs remained structurally higher. Governments adjusted visibly. In the United States, Congress established the Strategic Petroleum Reserve in 1975. Fuel efficiency standards were introduced for automobiles. In France, investment in nuclear power accelerated. Across Europe, speed limits were reduced. Public buildings dimmed lights. These measures addressed consumption. They did not resolve inflation. In 1978, global oil markets tightened again. Iranian production declined amid political unrest. In early 1979, the Shah left Tehran. Output fell by more than 4 million barrels per day over several months. The spot price rose above $30 per barrel by 1980. In nominal terms, crude had increased nearly tenfold from its 1972 level. The second shock differed from the first. There was no formal embargo. Instead, traders bid aggressively in anticipation of shortages. Inventories were hoarded. Tankers waited offshore. Screens in trading rooms printed higher offers every hour. In the span of 11 minutes on one March morning in 1979, a Rotterdam cargo changed hands twice. Inflation surged again. In the United States, it reached 13.5% in 1980. The United Kingdom approached 18%. Long-term interest rates climbed into double digits. Bond markets priced in continued erosion of purchasing power. Traders saw chaos. Central banks saw credibility risk. At the U.S. Federal Reserve, Paul Volcker assumed the chairmanship in August 1979. Within weeks, the Federal Open Market Committee shifted operating procedures. Instead of targeting interest rates directly, the Fed focused on controlling money supply aggregates. Short-term rates were allowed to rise sharply. By early 1981, the federal funds rate exceeded 19%. The immediate effect was contraction. Mortgage rates moved above 16%. Housing starts declined. Unemployment in the United States surpassed 10% by 1982. In the United Kingdom, policy under Prime Minister Margaret Thatcher tightened monetary conditions as well. Industrial output fell. Strikes intensified. The official statements emphasized stabilization. The market understood restraint. Developing countries faced different constraints. Loans extended during the mid-1970s were denominated in dollars. As U.S. interest rates rose, debt servicing costs increased. By 1982, Mexico announced it could no longer meet its obligations. A broader Latin American debt crisis followed. What had begun as an oil supply issue now appeared on the balance sheets of sovereign borrowers. In oil-exporting states, revenues remained high through 1980, then began to decline as demand weakened. Conservation measures and recession reduced consumption. Non-OPEC production expanded in the North Sea and Alaska. By 1986, crude prices collapsed below $15 per barrel. The system had adjusted, but not uniformly. Across the industrial world, inflation receded by the mid-1980s. In the United States, it fell below 4% by 1983. Central banks gradually restored lower interest rates. The severe recessions of 1980-1982 left lasting unemployment and industrial restructuring. Manufacturing employment declined in several regions permanently. The second-order effects were less visible but more durable. Monetary policy frameworks shifted toward explicit anti-inflation credibility. Central bank independence gained political support. In 1990, New Zealand adopted formal inflation targeting. Other countries followed over the next decade. The experience of the 1970s remained a reference point in policy discussions at the Bank of England, the European Central Bank, and the Federal Reserve. Energy markets also changed structurally. Pricing power consolidated within OPEC during the early 1970s, then weakened as non-OPEC supply diversified. Futures markets expanded. Financial instruments linked to crude became standard components of institutional portfolios. Later narratives simplified the period into a sequence of shocks. The term implied suddenness and external cause. It obscured the interaction between supply constraints, wage-setting institutions, monetary accommodation, and political incentives. The embargo of 1973 was brief. The inflation persisted for nearly a decade. Some accounts emphasized geopolitical leverage. Others focused on central bank error. In practice, the dynamics were cumulative. Once inflation expectations adjusted upward, reversing them required visible contraction. That contraction imposed costs beyond the energy sector. By the time oil prices fell in 1986, the architecture of policy had changed. Floating exchange rates were normalized. Monetary aggregates had been tested and partially abandoned. Credibility became an explicit objective. The Strategic Petroleum Reserve held hundreds of millions of barrels underground in Texas and Louisiana. The tankers moved again. The pumps stayed open. Growth resumed in most advanced economies by the mid-1980s. Inflation, while not eliminated, was reduced to levels considered manageable. The immediate crisis ended. The oil shocks of 1973 and 1979 did not dismantle the global economy. They redirected it. Energy efficiency improved. Financial flows globalized further. Debt burdens shifted across continents. Central banking evolved from reactive management to preemptive signaling. The institutions survived. The pricing regime changed. The policy consensus hardened. What remained unsettled was not the memory of high gasoline prices or long queues, but the structural tension revealed beneath them. How economies built on stable input costs respond when that stability disappears, and how long it takes for expectations, once altered, to return to something resembling anchor.